Hello everyone, hope you guys are doing well. Well, a couple of days back, a friend of mine came to me wanting to know whether he should be investing in a particular company or not. And the first thing that he told me was, कि boss, इसका PE multiple तो 20 के नीचे है. So it is a very highly undervalued company. इसमें तो मैं invest करना ही करना है. So it raises a very fundamental question कि ये 20 वाला PE multiple, 20x multiple, is it the right way to gauge whether a company is undervalued or overvalued? Actually, when should you be using the PE multiple? What is the correct way of analyzing the PE multiple? How can you derive the valuation of a company using the PE multiple, etc. and etc. All these questions will be answered in today's video. So stick around till the end. So let us now begin with the video on complete analysis of PE multiple part 1. So this is going to be a 2 parts video. So the topic that will be covered about the PE multiples will be done in 2-part video. Okay. So because the first part would be all about understanding the PE multiple, when to effectively use it, how to use it, and etc. So basically, what is the use of PE multiple? The PE multiple can be used to know if a stock is undervalued or overvalued. Okay, so this is the basic understanding that everybody has, but you should know that the undervalued and overvalued aspect will come into picture when you compare it the PE multiple with the peers or the industry or the previous year's average of the company's PE multiple. Then only you will know whether the PE multiple is undervalued or overvalued. Second part is you can determine the fair value of the stock using the PE multiple as well. That is, if you know that the share price is trading at 10, you can know or you can forecast that the that the share price could go to 20 in coming 2 years or 1 year, depending on the multiple that you use. So you can either understand whether the company is undervalued or overvalued, or you can determine the fair value of the share. So we will cover the first part here, and how to use the PE multiple to know if the stock is undervalued or overvalued. And we will also highlight some important characteristics of the ratio, that is the PE multiple, which will help you understand more effectively how you can use it, what are its limitations, whether you should be using forward or trailing 12-month multiple, etc. So the basic question is, what is a PE multiple? The PE multiple is one of the most widely used metrics for investors and analysts to determine the stock valuation. The formula is very simple, that is price to earnings per share. Okay, so that basically signifies how much the share price would be, the current share price. If you are analyzing the company right now, then the share price as on now would be in the numerator, and denominator would be earnings per share. Earnings per share could be trailing 12 months, that is last 4 quarters earnings per share, or the forward earnings per share, that is the in coming years what could be the expected earning per share for the 12 month. Okay, so the formula is very self-explanatory, share price divided by the earnings per share. That is how much the company is being paid versus the share versus the earnings that it is currently making for the shareholders. So PE shows what a market is willing to pay today for a stock based on its past or future earning. That is, your numerator EPS could be based on the past 12 months earning or future earnings. A high PE multiple could mean that the stock price is highly relative, is high relative to the earnings and possibly overvalued. Okay, let me read it again. A high PE multiple could mean that the stock's price is high relative to the earnings and possibly overvalued. Okay, hope this is clear. And conversely, a low PE multiple might indicate that the current stock price is low relative to the earnings, because the formula is such that is share price divided by earnings per share. Okay, so basically we are trying to understand how much the people are willing to pay in relation to the earnings that the company is providing to the shareholder. So a PE multiple is nothing but a ratio, and for a ratio to make sense, it needs to be compared to something. Okay, so just saying कि 20 का multiple is the right way to understand whether the company is undervalued or overvalued is a myth, and let it be a myth, and don't invest your hard-earned money based on that 20x multiple, that's something you have seen on a YouTube video or something. So saying that a 15x PE multiple is low would not be correct if the industry multiple is only 10x. So if the industry multiple is 10x and the current company's P multiple is 15, and you are still saying that the company is undervalued because it is lower than 20, is absolutely wrong. So on the contrary, if the industry multiple is 10x and your current and your company's P multiple is 15, there is a high possibility that the company is overvalued versus the industry. Hope this is clear. Now the fundamental question is how to analyze the PE multiple. You can compare the PE multiple with other company. So in this slide we will consider comparing it with the other company to know whether the company is undervalued or overvalued. Example, other things being equal, let's say company A and company B are doing the same business, have same attributes, debt, tax, region, product, etc. But A has a P multiple of 20x while B has a P multiple of 10x. So one can say that company B is undervalued versus company A because it's in the same business, and when you are comparing it with other company, all you are going to understand is whether your company is undervalued or overvalued versus the other company. Here you have to make sure that the company you are comparing it with is a very proper peer, that it should have the same business, similar product line, segments, regional exposure, etc. Because if you compare it with a company which is not in the same industry, then the P multiple changes from industry to industry. So P multiple of 10x could be normal within one industry, and it could be 20x, which is a normal multiple in other industry. So you need to make sure that the company you are comparing it is a proper peer. Other things being equal, if you decide to choose for investing in a company within IT sector, then you have to compare the P multiple for TCS and Infosys. So these are two peer. As an example, I am showing you. That is, you can compare TCS with Infosys and compare the P multiple. Let's say you are deciding to invest in a company between TCS and Infosys. If the P multiple of TCS is 20x while the Infosys is 25x, then you can choose to invest in TCS since it is relatively undervalued versus Infosys. Okay, hope this is clear. This is how you analyze a P multiple by comparing it with another company, that is a peer company. Now comparing the P multiple with with the industry P multiple. Other things being equal, we'll move on the same line. Let's say a company A is a auto parts company and A has a P multiple of 20x, while the auto parts industry P multiple is only 10x. So one can say that company A is overvalued versus the industry. So now we are comparing it with the industry multiple. Here you just have to make sure that the industry you are comparing with your company is a proper one. It should be in the same business and similar product line. Okay, the industry P multiple data is available on NSE website. You can check my previous videos where I have shown you, or you can compute industry P multiple using average P multiples of many peer companies. So, example, if you decide to choose for investing in a company within IT sector, then you can compare PE multiple of TCS and the PE multiple of IT sector on aggregate basis. Okay, if the here again we proceed with the same example. If PE multiple of TCS is 20x, while the sector is 25x, then you can choose to invest in TCS since it is relatively undervalued versus the sector. So it totally depends on the interpretation is totally dependent on with what you are comparing. In the first example, we compared it with the peer company. Now we are comparing with the industry P multiple. Comparing P multiple with past year's average P multiple is the third methodology that generally people use along with comparing it with the peer companies. Other things being equal, let's say company A has a P multiple of, now we are comparing the current company's P multiple with its own average 5 years or 10 years P multiple. Other things being equal, let's say company A has a P multiple of 15x, while past 5 years average P multiple is of 20x based on the 5 normal years. So you can say that the company is undervalued versus the past P multiple. That is, people are now paying less, currently paying less compared to what they have been paying in the past years versus the EPS development. So you can say that the company is undervalued versus its own last 5 years P multiple. So the basic thing that you need to understand is the 5 years average P multiple that we are considering should be based on the normal years. So you should not be taking into consideration, for example, 2021, because it was heavily affected by pandemic and all the share price of all companies was down and were not correlated to the EPS mostly. Here you have to make sure that the past year's average multiple is based on normal years. That is, exclude one of year from the average computation. It could very well happen that for the particular company that you are comparing it had a one off year, let's say 2 years back. So you should exclude that while computing the 5 years normal P multiple. This is way better than comparing it with industry or peer, since you know that the market is valuing the company over the year and you will have no problem in choosing the correct peer or industry average. So it is a very ideal methodology that one should be using, that is compare it with its own past 5 years or 10 years average P multiple. Hopefully this clears the first part on how to analyze the P multiple. You can either analyze it by comparing it with the peer company, comparing it with the industry, or you can compare it with its own average P multiple of past year. So you can tell whether it is undervalued or overvalued by comparing with these three comparable attributes. Now the first and foremost thing that we need to understand is it is not always ideal to be used for valuation purpose. This is very contrary to the common belief that everybody should use P multiple. It is a very good understanding point that we can do a primary analysis based on P multiple, but not an ideal multiple that you would be using for valuation always. If you look at the analyst income statement, then the denominator, that is the EPS computed, is computed at the last of the income statement. Below is the rough structure of income statement. So how do we arrive at EPS? So if you analyze any income statement, this is how we arrive. Sales less cost of goods sold, you will get gross profit. Gross profit less SG&A, you will get EBITDA. EBITDA less depreciation amortization, you will get EBIT. EBIT less interest income and expenses, you will get PBT, that is profit before tax. Less tax, you will get net income. From that net income, you have to deduct minority interest. Then you will get net income to shareholders. And net income to shareholders, when you divide it by the number of shares outstanding, you will get EPS. So EPS is something that is computed after so many deductions. Now, why is that important? This is what we will be covering now. EPS component in the P multiple is computed after reducing depreciation amortization, which could differ from company to company, because depreciation amortization policy is determined by the company. It could be high or low for any company. And it is also computed after reducing interest expense, which could also be different from company to company based on the capital structure, or could differ even year on year basis if you have repaid your debt, etc. It is computed after adding interest income, which could also be different from company to company and could differ year on year basis. After adding other income, that is non-recurring income, expense and various one-offs, which could also be different from company to company or could differ from year on year basis. It could happen that you are comparing two companies, whereas company A's EPS is down because it is doing some restructuring expenses. Okay, it is computed after tax expense or income, which could be different from company to company or could differ from year to year. Again, change in the number of shares outstanding from buyback or issue is also possible. So EPS in the denominator for the formula makes P multiple a very hard comparable figure versus the peer or previous year's average. That is why P multiple should not be solely relied for valuation purpose. Okay, because there are so many variable factors while you are computing EPS, that makes it a very hard multiple to be compared with peer company or its own 5 years average. Hence, analysts prefer to use EV/EBITDA, EV/EBIT multiples, etc. Okay, that topic is for some other day. But hope you guys understood why it is not an ideal multiple always to be used for valuation. Well, you can get a primary idea whether the company is undervalued or overvalued, but you should not rely totally on the P multiple because of the following shortcomings that I have already told you. So does that mean it is not suitable for valuation? Well, that is not the case. Not used for, absolutely not. So when should you use the P multiple for computing fair value? P multiple is a good measure for equity value of the company since it considers the residual profit as the denominator. Now, for running a business in a stable industry, the PE ratio could be a good measure. So P multiple could be a good measure for valuation basis when the company has been working in a stable environment, has been doing its activity from past so many years in a stable industry, has a stable capital structure, etc., etc. So you should be using PE multiple for valuation purpose. If I mean, you can take PE multiple as a primary mode of valuation in a company when it is working in a stable industry and has a stable business. This is because the EPS would be factoring in the same amount of capital structure from year to year basis, the same amount of tax structure also from year to year basis, if the operations of the company has been stable. So an already established company which has reached a stable level with respect to its business over the past years and has a stable capital structure and a stable margin, P multiple would be ideal for its valuation. So you can also use P multiple as a primary mode for valuation in such a company. Well, you can still use P multiple for making preliminary assessment on checking whether the stock is undervalued, since price and EPS are two things that are easily available for all companies and to common people also. It is very easy to analyze. But then you have to deep dive into the company to make the valuation. Hope this is clear where you should be using P multiple as a primary mode of valuation. Now, forward or trailing multiple. This is a matter of debate for some people. I'm not sure why. P is typically calculated by measuring historical earnings or trailing earnings. This is a typical calculation that people do. Unfortunately, historical earnings are not of much use to the investors because they reveal little about the future earnings, and price of any share price of any company is always and always will be a function of its future earnings and not the past earnings. Okay, the forward multiple of a company, how we calculate forward multiple is typically the trailing 12 month P multiple is what people use, that is price as on date right now divided by the last 12 months earning per share. Okay, but that is not ideal. If you have an option to choose between trailing 12 month multiple and forward P multiple, always go for forward multiple if the forecast is reliable. The forward multiple of a company is nothing but current share price divided by next year's forecasted EPS, or whichever year you want to estimate and compare. Here you can compare with the forward multiples and not historic multiples. Okay, you can compare the forward multiples of peer company, compare it with the industry forward multiple, and then assess whether the company is undervalued or not. The forward multiple is generally available on data aggregators like Reuters, Bloomberg, and other websites. But again, that is not something that is easily available and not mostly reliable if the analysts are not reliable. It is always more correct to compare forward multiples rather than trailing 12-month multiple. And this is a very shocking phenomena that in the YouTube channels many people subscribe to the fact that people should be using trailing 12-month multiple. But if you have an option to compare either forward multiple or trailing 12-month multiple, always choose forward multiple because the share price is a function of forward earnings. Okay, this is because the share price in an ideal situation of a company is a function of company's future earnings and not the past earnings. So if you have a reliable database where you can choose forward multiple, then always use forward multiple rather than trailing 12-month P multiple. But since the forward multiple is not easily available and sometimes it is not reliable enough, as you have to access the data aggregators by paying them certain amount, people are using trailing 12-month EPS. We'll consider a very simple example to understand this. On the left hand side, you see, on your right hand side, you will see forward basis comparison, and the left hand side you will have trailing 12-month P multiple. So first we'll see the left hand side. Company A has a 15x multiple, whereas company B has a 20x multiple based on the past 12 months EPS, that is trailing 12-month EPS. You would say in such a situation that company A is undervalued versus company B. Whereas in the second scenario, when you are comparing the forward multiples, company A has a forward multiple of 20x, whereas company B has a forward multiple of 18x. Then in such a situation, you can clearly say that company B is undervalued versus company A. Whereas in the first case, you said that the company A was undervalued. So in such a situation, you would always go for forward multiple because trailing 12 multiple could be misleading also sometimes. Answer is B, that is you have to choose the forward multiples and you can say that the company B is undervalued because the price is a function of future earnings. Hopefully you found the part 1 of this video helpful. In the next part we will understand how to use P multiple to compute the fair value of share, and this would mainly be the Excel working to understand what is the possible upside or downside for the shares. Don't forget to check the links provided in the description. The link to the website is provided in the description for the course that I conduct. Okay, or you can WhatsApp me on this number as well. If you found this video helpful, then don't forget to like, share and subscribe to our channel. Your support is what keeps us going. Thank you so much.